Good morning. I'd appreciate opening hearts, not minds. So the topic that I'm covering is a question: EdTech, gold rush or tulip mania? And the intent here is to look a bit more at capital markets than maybe we've covered in these previous sessions, to provide somewhat of a context for what's going on in what we're referring to as the EdTech industry. Some of this, if you're not that familiar with the capital markets, might seem esoteric, even a little bizarre. And some of the numbers that I'm going to talk about are vast. And perhaps not that relevant to the Israel market today, but I still think it's important to understand what's going on outside Israel as perhaps a harbinger of what can be going on inside Israel in the coming years. And the most important thing are, I believe, the lessons that we could take away over the last few years. So for starters, let's talk about why people are inclined to talk about EdTech as a gold rush. As you know, the gold rush was a phenomenon in the 19th century, and hundreds of thousands of people moved to California to find gold, and it completely transformed that state, and not just the US, but the rest of the world as well. Generally considered a good thing. Wasn't that good for Native Americans, but we'll overlook that for the time being. So when we think about the gold rush, what are some of the signs of a gold rush? I would say the conference circuit is a pretty good indication that there's something going on. So we just got back from Utah a couple weeks ago. We've been to this conference for the last 8 years or so. Every single year, the attendance multiplies. This year, over 3,000 people were there. Attracts luminaries like Bill Gates, Condi Rice, Richard Branson was there a couple years ago. So ASU GSV, that's one conference, and I'm just focused on conferences that tend to address investor issues. There are a host of other conferences that are truly industry conferences focused more on teachers, but these are the conferences that really attract the miners, people who are hunting for gold. So South by Southwest EDU over the last handful of years have had a number of conferences as well. Again, a younger Bill Gates appears at this one. New York is now getting into the swing of things. For the last 2 years, there's been a New York conference. So suffice to say, in regions around this country, around the US, and outside in China and in Europe, there seems to be a movement towards bringing people together to check out startups and find the next big investment. So why is this? So if we look at this slide, it gives you some sense that this is a global figure. $8 billion has been invested by the year 2015, a very significant increase since 2006, about a 16% annual growth rate per year over the last decade or so. Large number, pales in comparison to some other segments, but still, that's a lot of capital being invested. So in the US, and if you were here last year, I featured this slide as well, there's a whole ecosystem of venture capital funds, many of whom are designed specifically to invest in the education sector. They're not multi-industry funds, but specifically the education sector. There are also private equity firms, private equity meaning they invest in more mature companies that are generally generating profit. So we know here in Israel, we're still talking about education in a very, very different way, in a way where it's more considered an impact investment opportunity, not so sure there's an ROI, the market's too small, not a lot of investors allocating capital to this asset class. I would say to investors, don't lock in on that thinking. If this market evolves the same way as the US market has evolved, we'll look back at this and say, it was early, I should have been looking at deals because I missed a bunch of them. There's no reason why what you're seeing on this slide shouldn't happen here. And while I understand that the Israel market is a lot smaller, I also know that most Israel startups aren't starting up to build a business within the borders of Israel. They're always looking for global opportunities. Just a quick peek at some more established funds, NEA, Insight, Providence. These are large private equity funds and growth equity funds. NEA has 11 billion of assets under management. Insight, 13 billion of assets under management. Providence Equity, 50 billion of assets under management. They all have substantial education portfolios, and I could assure you when they make the decisions to allocate capital, they're not doing it out of the goodness of their heart. They're not doing it because there's an impact. For sure, just about everything that they invest in does have that double bottom line benefit, which we know they really, really like. But if their investment analysis can't convince an investment committee that they can achieve an appropriate return on investment, they are not making the investment. So this gives you a sense of what's been happening in the recent period. This is really the last year, and we continue to see significant capital invested in the US and China as well. And in China, the numbers always seem to be a lot bigger. Things scale very, very rapidly in China. But you'll see in the US, the largest deal recently done was for a company, EverFi. I'm going to talk about that a little more in a second. And down the list, these are substantial sums of money being allocated to large companies in the US and China. Why? Well, these companies are becoming increasingly more valuable. So this is a snapshot of the 10 highest valued private EdTech companies, and you'll see a couple things of note. One is we now have 4 legitimate unicorns in the EdTech industry. A unicorn is a company that's achieved a valuation of $1 billion or more. And we've seen significant growth from 2014 to 2017 in the value of the top 10 most valuable companies. So companies are becoming more valuable, and in general, that means that they're performing in a way to justify that higher value. So I wanted to just take a look at a couple of older vintage companies that also had invested a lot of capital to see what happened to them and to dig a little bit deeper. So the first is Amplify. Amplify was actually started by News Corp and Rupert Murdoch, who decided he wanted to get into the education business. So he bought a company called Wireless Generation for about $400 million. He then proceeded to invest another $1 billion in the company. So the total amount of investment is approximately $1.4 billion. That's a lot of money. Coursera, we talk about a lot here. I think there was a lot of discussion of MOOCs. So Coursera is a MOOC. Amplify was a company that applied a lot of digital technology to the learning process, data-driven, supplemental education products focused on literacy, language arts, and the like. And then they went on to build a full middle school curriculum. Coursera is a MOOC. I think most people here know what Coursera does. Coursera has raised $146 million. Edmodo, I'd call Edmodo a LMS Lite, a learning management system Lite for the K-12 system. When it came out, looked a lot like Facebook for the classroom. $80 million raised. Mostly, the interesting thing about Edmodo was it was a freemium model, which means they were basically giving it out to teachers, looking to gain adoption, and then upsell into districts. Became very popular with teachers, millions registered for it. And then the last one I want to focus on is Newton. So Newton, $160 million, probably the most sophisticated technology introduced into the education sector, could probably, win in a wrestling match with Watson, despite the commercials. But a big sum of this capital raise was invested in the technology. It's considered a black box. It does a bunch of things that nobody really understands. Put content into the black box, and out the other side comes adaptive curriculum that's highly effective in personalizing education for a range of students. So what's the case for Tulip Mania? Why, after all this, why would we talk about EdTech being Tulip Mania? So let's look at the companies that I just featured and see what happened. Amplify, real quickly. As I said, acquired for $400 million. News Corp invested another $1 billion. And no sooner did they acquire this company than they ran into a fair amount of controversy. Lost a large contract in New York State for $27 million. Decided to build a closed system of curriculum and hardware. And unfortunately, one of their tablets caught fire in the only district that had adopted it. Public relations nightmare. Began to lose a lot of money. Started losing market share to Google. Built a huge curriculum project and gained virtually no adoption. And ultimately, as a public company, the board decided that they had to take a $370 million write-down. So most of the value of the purchase was wiped away. And ultimately, they decided to sell it back to the management team, who was backed by Steve Jobs' widow, Lauren Powell Jobs, Emerson Collective. So Amplify lives to fight another day, but in general, it was a very painful process for News Corp. I just want to go back to this. I mean, you can't make this stuff up. The tablet literally caught on fire in a classroom. That's bad. Coursera. Everybody knows completion rates at Coursera have been anemic, below 10%, some say 4%. I guess this is a depiction of one of the Coursera students. So, if you can't deliver high completion rates, it's difficult to turn that into a revenue model. Edmodo, the freemium experiment just didn't quite work. The teachers liked it, but that didn't mean that they were able to upsell into the school district. So generally, lots of registered users, but no revenue. And then Newton. All of these articles are basically announcements of new business models. They have still not found a business model which quite works. And most recently, Pearson, who was their patron saint, most of their revenues came from Pearson. Pearson had made an investment, decided that they were pulling the plug on it and going in their own direction. So where does this leave us? First, I would say all of the negative cases that I just described, I think are an indication of something in the education sector, which is it takes a long time to build a great education company. And there's not a lot of room for error. You got to really thread the needle. The issues with Amplify, I think, mostly were self-inflicted, so I would set that aside as a separate case. But the other ones, the Coursera's, the Newtons, the Edmodos, these are companies, in the case of Coursera, over 20 million have registered, over 2 million courses have been delivered on that platform, Over 1 million students have taken courses. They will figure out a business model. It's just going to take some time. Edmodo, millions of teachers love it. There is a business model there. It's just going to take some time. Perhaps they need to merge into another company that can bring something else to the table, something that will make administrators who control budgets decide to spend for the product. So just real briefly, this is a high-level view of what's happening in the investment markets over the last 7 years. You see in 2015, a bit of a spike, $3 billion invested in 2015. I wouldn't get too concerned about the drop-off in 2016. There were a couple of very large deals in 2015 that skew those numbers. But you'll see, for the most part, a growing market. Shouldn't get too concerned in any given year whether there's 550 deals or 700 deals. I would say, safe to say, the venture market is cooling off a little bit, but it makes sense. As I said, there have been a couple of very high-profile investments that have gone sideways. Investors are probably stepping back. That impacts the additional capital that they have available to put out for new investments. But I would expect that the bars to continue to rise pretty steadily in subsequent years. M&A activity, similar trends. So I just want to focus on a few companies and why we're so bullish about the sector and why I feel like everyone in this room and beyond should be as well. 2U, a success story. It's worth going into in a little more detail. So we had John Katzman, who was the founder of 2U, on last night, and he described briefly the question that he asked when he formed the company was, why are the great universities irrelevant online? And he realized they're risk averse and they can't afford to invest in new programs to put themselves online. It's just not the way that they're set up. So he decided to do it for them. And by doing it for them, it meant that he invested upfront in building the platforms and marketing to new students. Cut to today, 25,000 students have enrolled in these universities. They've placed 32,000 graduates in jobs, high retention rates, and they cover a variety of academic disciplines. These are some of their partners: USC, Georgetown University, Berkeley, NYU, Yale, etc. So when you offer a compelling value proposition like this, revenue follows. So in 2012, they did $30 million in revenue. In 2017, they're projecting 270. It's a real company, a real EdTech company, a real success story. So what follows from that? Valuation. So you'll see in 2009, they were worth $37 million. In 2013, they went public. Market cap today is $2 billion. Simple idea, for the most part, really difficult to execute, but the value proposition was so compelling. That's how you create value in the EdTech market. Another company to focus on is EverFi. And I featured EverFi because I just think it's a fascinating way to solve a problem that's always existed in the United States, which is, how do you sell into the K-12 market? It's a brutal sales process. It takes a long time, it's very expensive, and it's really the death knell for a lot of companies. What EverFi wanted to do was doubly hard because they were interested in bringing into the school district non-core curriculum that they felt every student should have access to, but it wasn't math, it wasn't reading, it wasn't science. It was things like sexual harassment prevention, anti-bullying, financial literacy. There's no money for that. There should be. Kids should have access to that, but there's just no money for that. So what did the management team at EverFi do? They got sponsors for that. So you see a list of their sponsors, including National Football League, Google, Airbnb, a brilliant way to navigate around a problem. So trying to solve a very simple problem, difficult to execute, but their Their genius was in thinking out of the box and figuring out a way to do this without going through the conventional channel. And then you'll see they've gone from 36 million valuation in 2010 to 540. The revenue number hasn't been disclosed, but it's well over $100 million by this point. ABC Mouse, yet another one. Nobody heard of ABC Mouse 4 years ago. They've really taken advantage of mobile phones and the app stores. The app stores has enabled, in consumerizing technology, the ability to go straight to families. They created a product that was very compelling and overnight became a business that was generating north of 100 million in revenue. And capital followed. They raised $150 million at an $850 million valuation. They're now worth over $1 billion. Simple product, very effective product, leveraging what hadn't been available 5 years ago but is available today. Another success story. So what are the lessons learned? Real quickly. So this is an image of Amazon Go. The Business Insider headline is Amazon Supermarket of the Future could operate with just 3 staff. A lot of people in the EdTech market think about doing the same thing in this classroom, disintermediating the teacher because the technology could do it better, more cheaply. I'd say the first lesson learned is teachers, not technology, remain the secret sauce. And you would be surprised that there would be some dissent in other rooms. It's good to hear people agree with that here because it's such an obvious point, and it's been discussed over the last day or so. Enabling technology that extends teaching stands the best chance of winning. That means giving teachers more time, maybe to work with students who require more direct intervention. Technology seeking to disintermediate teachers is likely doomed to fail. And I just want to call out Achieve 3000, one of our platinum sponsors. We have a couple of Achieve 3000 technologists in the room today. This is the secret of Achieve success, is leveraging technology to extend the teacher. And just a chart to emphasize this, students that spend time with good teachers do better. A lot of research around this, don't need to go into it in great detail. This curious picture, this is actually a picture of the education market. It's clear? So the reason why this depicts the education market is because the education market is massive and it's got some enormous players. But if you take these players and you put them in a jar, you're still going to end up with a lot of white space. And that white space is space that entrepreneurs can operate in to create valuable companies. You don't necessarily have to go after the big rocks to replace the rock. You can figure out where the white spaces are and focus on that. So the lesson learned there is the market is massive. There's significant room to create scale and value within the white spaces and around the edges. I know Jack Charovsky wants people to go after big ideas. Is Jack here? And there's nothing wrong with that. But before you look to disrupt the system, you have to ask a question. Is the problem you're looking to solve mission critical? Is it nice to have or need to have? And we run into a lot of entrepreneurs who want to disrupt the system, but really what they're doing is creating something that just doesn't need to be purchased. It's not going to make things that much better. It's a better mousetrap maybe, but the market's not looking for a better mousetrap. So if you're looking to completely replace systems, existing systems, they have to really, really be broken in order to be vulnerable. The other mistake that we see made is entrepreneurs thinking that they're building platforms when what they're really doing is building point solutions or even functionality. We see a lot of companies that aren't really companies, they're just feature sets. And there's nothing wrong with that, but just make sure that you're raising an amount of capital that's consistent with that. And one other point, Google truly is a force to be reckoned with now. If you look at their increase in market share just in Chromebooks from 2002 to 2016, they went from 2% to 53%. So if you're going to operate in the K-12 market, and I would say higher ed as well, please be mindful of Google. You cannot beat Google. That doesn't mean that you can't succeed, but you just need to know if you're going into a place where they're interested in, it's going to be an uphill battle. Why is a science lab here? Because at the end of the day, scientifically based research and efficacy are the coins of the realm. We're talking about education here. We're not talking about fast food. We're not talking about cars. We're talking about education. You need to be able to measure outcomes. You have to prove ROIs. You need to be collecting data and doing something important with it. This is a really interesting contraption. It does a lot of different things. What we've learned is the best products don't always win. Distribution often is much more important than the quality of the product, unfortunately. And you need to be focused on decision makers who actually have budgets and can pay for your products. And the Silicon Valley mentality, software eats the world, does not always work. Social media, very delicate matter within academic circles. In general, teachers are not interested in Snapchat. This guy is very impatient. In terms of capital, patient capital carries the day. You need to be able to withstand setbacks, delays, and business model pivots. And I just want to dwell on this one quote from Lawrence Summers, who is the former president of Harvard University. I think this is wisdom that applies very clearly to the education market and investing in the education market. A good rule of thumb for many things in life holds that things take longer to happen than you think they will, and then happen faster than you thought they could. As you're watching Coursera, keep that in mind. And then we just never want to forget who, at the end of the day, is the customer here. We're building products and solutions for these folks, and this is what's at stake. Thank you.